The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Darrell Martin.
All right, folks, come on back here to the Diagnostic Trading Hour. And right now we're checking out the market, seeing what everything's at. We got the S&P up 27 points. We have the Russell's currently up 37 points. We have the Nasdaq up 51. The Dow's up 230. So, lesson to be learned. You know, hearing all these things, markets crashing, markets flying, markets crashing. Forget all that. Just watch the charts, okay? Quit trying to figure out whether it's going to make new highs or new lows or go back if we're at the top, and just follow. Follow the charts. We got copper right now. It is up over 1%. We got gold. It is down 1%, 13 points on the day. Silver down 1.35. Natural gas currently up 2% on the day. We got oil is currently down 1.79, down $1.88. And corn moving 8.5 points. Soybeans, pretty decent move, 9 points right there, but corn almost a 2% move. Looking over at the currencies, we got euro dollar is it is flat on the day right now. And we got Aussie dollars up 5 pips. We got pound dollar up 7, and we got dollar franc is currently up 37 pips on the day, with dollar cat up 29, dollar yen up 72, Aussie yen up 71. Euro yen up $1.08, pound yen up $1.43, and euro pound is flat on the day. All right, that gets us caught up on where everything is. Last night, we had a little trade going on, right? We had the Aussie dollar interest rate came out. And looking at that report, I'm like, this isn't going to move. So they're not going to make any big changes. We shouldn't expect a whole lot to come out of this report. And we really didn't get a lot out of the report at all. There's a couple weird swings that happened. It made me a little nervous on a couple of the moves that were going on. But overall, still, we did not get a massive move. We go high to low. We'll go here. Here's our high. Here's our low right there. Got about 60 pips. But that's high to low. That's not like pre-announcement to actual release, okay? And meaning like it'd be about half that if you were trying to do a straddle or strangle. So what was I looking at doing? Okay, so how did I take advantage of that? Well, I talked about the iron condors and going in and looking at those trades. So let me pull up just the order history on here on how to do those. And I looked at, I scaled into them. I thought it was a little weird what was going on earlier in the day, so I didn't get real heavy to begin with, and then I layered up heavier as we got into the evening. But first I'll go in just the first one I did for you right here. And this one was, I was looking at getting in. This is around 6:30, okay? So right over here, pretty much getting in like right at this time at 6:30. And so 6:30, we're looking at this, and we got a couple contracts. We have the 87.30 to 89.30. So let me draw the boxes. Right over here, we got 87.30 to 89.30. So this is about 89.30 right here. And it goes all the way down there to really expand this thing out down to 87.30, okay? And then we have another one that's 87.30 up to, 89.30 up to 91.30. And let's see here, draw that one. All right. And I need to sneeze, but every time I hit the the silent button, I don't sneeze. Okay. There we go. Okay, so we got 87.30 to 89.30. And now let's get back over here. Let's get a little bit more zoomed in. And now these are expiring, okay, at 11 o'clock. So take these right here down to 11. right there to 11, just to make sure I'm lined up on the 89.30. There we go. Just bring that one up a little bit. And then this one right here. Okay, so now normally what we would do, our normal move on this trade would be to go in and buy the upper box right here, or spread, whatever you want to call it. Buy this upper one and sell the lower one. Because, hey, there's going to be a move. If we can get on a good low risk, then we have a good trade. Okay, that's sort of the idea. And you could have done that. You could have went in and, bought the straddle, basically is what it is. And if you did, you would have paid for the 89.30 to 91.30, would have been at 89.49. And so right over here at 89.49, okay? Would have been where you would have bought this specific straddle. Then you could have sold. This was a straddle. We're going to talk about the iron condor in a second. If it was a straddle, you could have sold the 87.30 to 89.30 at 89.09. Okay? So right down here, 89.09. Pretty far down there. And that's where your sell is. And your risk would be basically if it expires in between this range. Max loss would be like right at the center. That's unlikely usually, but you'd be surprised how markets can come right back. And just so you can see something that happened here, look at the market and look where it expired. 2 ticks off. Okay? So, I mean, a perfect iron condor. But a horrible straddle. Basically, you would have had pretty much max loss if you would have held on to this thing. Now, what if you would have taken profit? What would have been your, what would have been your risk, your one-to-one goal, all that fun stuff? If we go in and we throw up a few calculators here, okay? If I would have done a straddle, and I would have bought the upper one at, let's see here, 89.49, so 0.8949 minus 0.8930, $19. Okay? 19 pips, every pip's worth $1, $19 in risk on my long. Now on my short, right up here, if I would have went in, I would have sold that and sold it at 89.09. Then 0.8930 minus 0.8909. $21 in risk if I was doing a straddle. So my combined risk, 21 plus 19. Okay? And my one-to-one would mean I would need to make the total risk of $40 plus the risk on the other side of the trade. So basically, I mean, these were both at 20. So 40 plus 20, 19, 21. So I needed the market to move either up or down from where it was 60 pips. Not the spread, the market. Okay, so the market actually has to move 60 pips higher for my one-to-one take profit on a $40 risk. Okay? So with that, then we can go, okay, well, what would that mean? And you go, okay, where's the market? Right over here. And I need to move up to, higher than that. Let's keep going. We need 60 pips up. Or we need 60 pips down. Okay? And actually, I guess it'd be 59 and 61, but we'll just go with 60. We'll make it real simple. Okay? And let me see here. We'll bring that a little bit more back into focus and then just drag it down just enough. Okay, so this area right here, this 60 pip line, that would have been my, my profit, okay, level. And this right here, my 1-to-1 take profit level. Anything past that could, of course, make more than 1-to-1. But that would be my 1-to-1 take profit. Now, what would be my break even? Well, I basically need to have the market move enough to cover the risk on my trade plus the risk on the other side. Okay, so whatever I bought it at, so let's say I risked $20 on the other side, then I need to have the market move basically, up 40 pips, right? So if the market's at like flat right here, and I risked $20 on this one, I risked $20 on this one, and the market moves up, well, that's great. I'm break even on my first one, but to be break even, to make enough to cover the loss on my short, I need to move up 40 pips. Okay, so right there. So basically, I need about a 40 pip move. And there we go. So, and then now on the other side, I had to make 40 pips to the downside just to be break even to recover my loss on the other side of the trade. All right, so right here, you call this your, basically your break even line. Okay. And right here, there's a lot of lines on a chart. And a break even line right there. Okay, so this is, I'm going to lose money if it expires anywhere really inside of this orange line. Now, I'll lose $1 every tick closer it gets to the center. Okay? So basically at 40, I'm break even. And all the way back down, and I'm making that. Now, if I want to make a true 1-to-1, I need to net profit. Okay, and this is where it gets tricky. Okay, that's a 1-to-1, like if you're just looking at 1-to-1 on one side. That's what we were calculating on the 60 pips. And this is what gets people. So it sort of messes them up. Okay, on these straddles. And this is where actually the iron condors get really cool if you can, if you grasp it all and put it all together. And okay, so we'll cover that when we get back. But I'm going to show you what a true 1-to-1 is and how far the thing really had to move. When you get that, then you're going to see why I like the iron condor so much. We'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're new to TFNN, then you've probably heard some of our hosts and traders talk about the exciting charting program, The Art of Timing the Trade Charts. Tuesday, March 11th at 6:30 p.m., Dave White and Tom O'Brien will be hosting a live study session for anyone with a subscription to this exciting charting program. During this hour-long online workshop, Dave and Tom will lead a brief presentation along with taking questions from those that attend. Right now, we have a great deal for all new subscribers. You can sign up for the Art of Timing the Trade Charts and get your first entire month for only $1 while gaining access to this live event with Tom O'Brien and Dave White. For more information on how this exciting charting program works, you can click on the Charts button on the front page of TFNN.com today and check out some of the videos that walk you through a variety of the features included. Sign up now by taking advantage of this exciting offer for just $1 before it's too late. Visit TFNN.com today.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And just laughing at a comment I saw there. Okay, so far what we have is we went in, and I know this sort of starts getting messy. I try to get some stuff off the screen for it to make it a little bit easier. But I'm looking at a straddle, because once you get straddles, then it's easier to understand iron condors, because they're just the opposite thing. And the risk-reward model is the exact same. It's just inverted. So you'll see here in just a second. So that's why I'm walking through the straddle, because it's a little easier to get first time around. Okay? Now, what we did is we looked at having a buy right here. This is where the market was. Okay, this is like, 0 hour. And let's see if we can go in. We'll make that one just black. Okay, so like right where we were when we got into it. Whatever, that'll work. Okay, this is our buy price right up here. And this is our sell price right down here. And our break-even zone is this orange section. Okay, so basically that's where if I risk $20 on each side of the trade, then I need to make at least $20 on one side or the other just to be break even at the end of the day. Okay, so we did about a 40 pip move up or 40 pip move down. So you got to about a break even. You could have got out. We did get a nice 70 pip high to low, but that wouldn't have been enough for you to make any money on the trade. Now, this is the mistake I'm going to go through with you. And if you get this, if you'll understand this mistake that most traders make when they do this, then you'll also actually be able to start taking advantage of iron condors. Okay? Because this is what makes it hard for people to fathom doing the iron condors. To make a 1-to-1, I need to make my total risk, which was $40. okay, plus my risk on the other side, which would be $20, because $20 on each side, okay? And that'd make my total risk, basically that means I need to make 60. If I started with a $40 risk, I need to make 60 to end up with a $40 profit, because I need to expect, now every once in a while you get lucky, but I need to expect that one side is going to have total loss, which is fine. If one side loses 20, the other side, makes 60, all right? Then I make 60, lose 20, I net 40 on a $40 risk. I'm net up $40 from what I started with. When I say 40, it can be 40, it can be 400, it can be 4,000. Okay, it's all how many contracts you're doing. So I'm just making it small and simple to make it easy. You can multiply based on your account size and your risk management. So I need to make $60. Well, then what people do accidentally, okay, this is a very common issue, and they'll do one of two mistakes. Is either, one, they'll add 60 to where the market is, and they'll think, hey, the market just has to move 60 pips, and hey, on average, this thing moves 60 or 70 pips, high to low. So great. Well, the market doesn't have to move just 60 pips, okay? The actual market has to move more than 60, because you need to make 60 on your spread, right, on the upper side, or you need to make 60 on your spread on the lower side. And remember, your spread, it has some room there. It has like 20 pips above the market. So you actually need the market to move 60 pips higher than where you bought your spread, or 60 pips lower than where you sold your spread. So in this case, since the market is 20 pips away from where you bought and sold, you actually need the market to move 80 pips. So that way one side can make 60. Okay? And so that changes our numbers up. We got to go back. We have to delete these out. And we're going to have to move them up here a little bit further. Move this one down a little bit further. This is our real one-to-one. And this is where a lot of people make the mistake, is they assume it has to move up 60. No, it has to move up 60 from where you bought. So if I bought right here, okay, then I want it to move up and make a net. I want it to make a $40 profit plus take care of the $20 loss on the other side. So I need it to make 60 from where I bought. And let's see here. Let's move that down right there. Okay. And now it's hard to see where the arrow is. Let's redo it. Okay, so since I bought right here, then I need to move up 60 from there. It's pretty close. All right, so right there, we'll bring that one down. Now this is my take profit on my long. I'll go ahead and put the take profit up on my short, and then we'll look at how to do an higher condor on this to take advantage of this market and why it was a much better strategy to do than a straddle. There, we'll be back after this break.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right. Let's check out where we're at. And what we're doing here is we're going through straddle, and it's really actually natural transition to iron condor when you get all the numbers down. We started right here at this price, $89.30. We had $20 risk on the buy, okay? So right there we had $20 risk on the sell, and so we had a $40 risk total on the trade. All right. The market moved to high to low of 58 pips, but again, that was a high to low, not 58 up, not 58 down. And an open to close of 2, okay, for basically max profit on the trade. And then if we go over here and look at, now that's on the iron condor. All right, so that's a straddle, $40 risk. Now, what I want you to understand right away before we even move further is that same risk, okay, would be your profit. Now, I mean, less a few dollars for bid-ask spread, okay? But let's just assume there isn't a bid-ask spread. I know there is, and I know it's a couple dollars on each side. But to make life easier for understanding, let's just act as if there's not one, okay? Just to make sure you can get the concept of the risk model, all right? So we got 20 pips, 20 pips. So either you could pay 20 pips on the buy and the sell, or you could get 20 pips, and you could invert it, all right? So either way, you can do this trade. Now, when I say invert it, what do I mean? Okay? Well, you basically could go in and, got the wrong button there. I'm trying to do a screenshot. Have it on video. There we go. All right, so right there. All right, so I could then go in and instead of buying the upper one, I could, sell it. That's a little obnoxious. And there we go. And come on. There. All right, so I could sell that one, and I could buy this one up here. So I could buy the lower one and sell the upper. And then I'd basically, instead of having $20 of risk, I'd have $20 of profit potential. And then up here, instead of having $20 of risk, I'd have $20 of profit potential. Now, this seems really scary. It flips things upside down on their head. But let's keep going, okay? So if we were doing that, and again, I'm going to go back, but I just want you to first understand that I could buy and sell instead of sell and buy. So if I did the opposite, I'd be doing basically an iron condor. I mean, it could be a butterfly, whatever you want to call it. It's pretty much the same, almost the same model as far as risk and profit potential. And I'm just trying to get some decent colors on here. All right, so we're going to flip back over, and we're going to make this back on the straddle side, okay? And then we'll come back to the iron condor side. All right, so we're buying up here, we're selling down here for the straddle. And we understand that $40 is our risk. We also understand that we need to make at least $20 on either side to cover the $20 loss on either side, because we have $20 risk on the buy, $20 risk on the sell. So the buy needs to make at least $20 for the sell loss to be covered, to be break even at the end of the trade, or the sell needs to make $20 to cover the loss of the buy to be break even on the trade, and that's as of expiration. Now remember, this thing only expired 2 ticks from where it opened. So if you would have held to expiration, you would have taken full loss on that trade. Okay? And that's what these orange lines are. There are break even. Okay? On a straddle. Now if we flip it, okay? If we flip it, and again, we go back to the colors over here, and we're going to use, I think, a different color of red and green every time we change. And I think I may have clicked the wrong one. There we go. Okay, so we flip it right over here. There we go. Like I said, different color every time. Then what's happening is now this orange line, okay, that was before our break even on our straddle, meaning it had to move that far for us to be break even on the trade. Well, now that is actually, if it moved that far, we would be break even. But if it didn't move that far, as of expiration, we would be break even on the trade. Okay? So right here, this is our break even line now on the trade. So it actually can move up 40 or down 40 pips, and we'd be break even, because that would mean that one made $20. Okay? And then one has lost $20. Because remember, if you started here and you sold, okay, so if you're backwards here, and let's put it this way. Okay, you sold this, you made $20. You bought this, you lost $20. Because you bought right here. Let me get a, so you bought right here, and you lost $20 because it went $20 lower than where you bought it. Well, the $20 you made from selling here, because you have a max profit down to the floor, would cover that $20 loss. Okay? So you basically have a 40 pip high to low break even, meaning I don't lose a dime if it's inside that, and the closer it is to the center, the more money I make. Okay, so every dollar it's above this orange line, I make an additional, basically like $1 to $2 here. Okay, so going all the way up, because I can make up to 40. So basically, yes, every dollar it's above the orange line, up to the black line, I make $1. Every ticket's below the orange line, I make $1 on an iron condor. On a straddle, every dollar it's below the orange line, I lose $1. Every tick above the lower orange line there, I lose $1. So we've just inverted the model by going backwards. And then you go, okay, well, what about, the risk seems massive. Now, again, you could have chose the 9 to 11, which I did went a little bit heavier on that one. You could have chose the 9 to 11, and you only would add 100 point wide, and so your box would have been like down here versus up here. But just to show you, what does the massive risk mean? You actually had a larger risk in reality on the straddle. Because on the straddle, where you bought this one up here, okay, and where you sold the one below it, then you were depending upon the market to move 80 pips when there was absolutely no. Now, if there would have been an announcement, if they would have changed it, yes, okay, that could have happened. We could have got some massive surprise move. It does happen occasionally, but it's rare, especially on these. So right over here, if you go in and you would have sold this, it would have had to move all the way down to this green line to be 1-to-1. Because remember, it has to move 60 ticks lower than where you sold, or 60 ticks higher than where you bought. Not just 60 ticks from where it is. Okay, so that was 20 ticks plus 60 ticks above where the buy on the spread, or 20 ticks plus 60 ticks on the sell on the spread. So I had a net range of a high to low of 100 and basically 60 pips on this trade. Now on an iron condor, I had 160 pips where I would be profitable, or I would not exceed a 1-to-1 maximum risk to maximum reward ratio for 80 pips up and 80 pips down on a trade that there was little to no expected move on. That's not too bad, okay? Whereas on a straddle, I was having to expect that the market was going to move 80 pips, again, with no major news announcement expected to come out. That's a big move. And also, I actually timed it on purpose. I timed it for 11 o'clock. I only needed like 30 minutes because that news announcement was coming out at 10:30. So I timed it to actually focus on that, and I'm like, hey, let's just maximize this, and that worked out great. Now, if I would have chose, I could have chose at 10, I could have chose a 12. I would have got basically the same result as I did on a 9 to 11 or a 6 to 11. The market did, finally make some moves a little bit later. So, but not much. I mean, see, we pretty much stayed in that range. Look at that. Most of the day. I mean, there was one little period like here, and then it sort of went back up to it again later, came right back, and we're basically at settlement. There was no change. There was no shock, no fundamental shock in the news that was released. And we didn't expect there to be a fundamental shock, but there was still implied volatility built in because at the end of the day, sometimes things happen. So there was a possible expected move built into that trade. And so instead of going in and buying this one and requiring the market to move up 80 pips or down 80 pips when I don't expect there to be any kind of interest rate announcement, I decided to go in and, like we said, do the opposite and go, this would be a lot easier just to fade this entire trade and go, I bet it's going to stay range bound by the end. And if it's not, I have a 1-to-1. Okay, I have a 1-to-1 risk reward ratio, not bad at all, by basically setting a stop to get out of the market if it hits my 1-to-1 level. Just because I have a max risk doesn't mean that I have that risk. Okay, it doesn't mean I have to take on the full. Like if I'm going to make 20 on a 250 point wide, let's see, how wide was this one? Let me check. The width, I want to say it was 200 wide. Yeah, 200 wide. So if I'm going to make $20, I got to put up $180 to make it. Okay, on both sides. So I'll put up like $360. It's not like, options where you get a credit on both sides. So it's quite a bit of capital you're putting up on the trade. $360 to make 40. Now you can't lose on both sides. Okay? If you left it open expiration, it's impossible because now I'm talking about like on a credit because it can't both expire above and below this line at the same time. Okay, like the market can't be up here and down here at 11 o'clock. It could be anywhere it wants to, but it can't be in both places at one time. So only one side could potentially lose. Now, again, you don't get the benefit of hedging. It would be nice if you did. But by doing like you do on an iron condor or on normal options. So you got to put up the margin. But your risk is not both sides. If you're going to leave it on to expiration, your risk is one side or the other. And you don't have to take that max risk on, just like you don't have to on an iron condor, or vertical or credit spread or whatever. You can close the trade before like it exceeds a certain point. So, like a lot of people use before one tick in the money and they're out, that type of thing. So we can limit our risk to 1-to-1 on a pretty high probability that if this thing just stays in between the orange lines, we're at least breaking even. Every tick above or below it, we're making money. If it breaks out of it, here's the beautiful thing compared to a butterfly, okay? On a butterfly, on the binaries, if it was one tick in the money, you'd lose everything on that one side. This one, you just lost $1. So $1, $2, $3, you only lose $1 for every tick, it's above that orange line. Here you lose $1 for every tick it's below that orange line. Okay, because we're going opposite, right? We're buying the lower and selling the upper. A binary, you'd lose everything if it was a tick above, if you sold, and everything if it was a tick below if you bought. So that's a really important concept to understand. That's the big benefit here, is taking advantage of there's only $1. Now, you only make $1, okay? So there's a flip side to it. You only make $1 for every dollar it's below. So you get the same profit pretty much as you would on a binary, which is important to understand. It's about the same profit as you would on a binary, okay? But you have a much better risk management control than you do on a binary because you only have $1 per pip versus everything, max risk. But on the flip side, the binary, if it's only one tick below the orange line, it would make full profit. It'd make all 20 anywhere between, basically underneath this orange line. So versus for every tick it's under, you make $1, whereas the binary would make all 20 one tick under. So for that close move, the binary would come out ahead. But if it was 2 ticks above, the binary would lose 4 times as much, or actually much more than that. Instead of $1, it'd be $80. So it'd be 80 times as much. So your risk reward is a lot better on an iron condor than it is on an iron butterfly. And so when I go in and I look at a straddle trade, how do you put all this together? Okay, when I go in and I look at a straddle trade, what I ask is I go, where is my take profit on the trade? Do I think that is within the expected range movement of the trade? And if not, then would I be better off doing a iron condor and flipping the thing upside down? And the bigger the news announcement, the more often the answer is yes. So FOMC announcements, NFP announcements, Aussie dollar, pound dollar interest rate announcements, things like that, that's usually when the answer is yes. You'd be better off doing an iron condor than a straddle and taking advantage of that premium collection. And it's just very important, though, that you do set stops, okay? And it's one of the features. We have a stop plug-in built in, and it makes life a lot easier when trading it. And it's real simple. You just go in, and you just put in it's a trigger, okay? So it's not a stop order. It's really just a trigger. It's a trigger to say, hey, when do I want to submit my limit order? And it makes it a lot easier to manage. So you can check that out over in the scanner there, but it makes it really easy to manage and take care of. But that's a summary. That's a straddle. That's an iron condor. And if you get the straddle, the iron condor all of a sudden starts to make a lot more sense because you realize you have a lot more room than you thought you had because you feel like you're only getting $20 or $40, but you realize what that means as far as a risk model. All right, we'll be right back after this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. the king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Join David Dwight as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks. All right, we got news coming up tomorrow. We got a lot of news, so I'm going to go through this pretty fast for you. All right, so hopefully you got your pen and paper. You're ready to go. We got the Aussie dollar is going to be releasing its GDP quarter over quarter. Expectations, not that big, okay? About 45 pips. About 54% of the times it break 50 pips. Might be another good iron condor trade, okay? Again, expectations about 45 pips on that release. And let's see, what else do we got over here that we can find out that we might be able to take advantage of? So that's the GDP there. And I'm just looking real quick as I can. And now the last move was massive. All right, be aware. It was pretty big. We got about 45 pips in 15 minutes. And then we got 50 pips a move before that. We got 20 before that. We got 25 before that. We got 4 before that. We got 3 before that. We got 60 before that. About 40 before that. We got about 30 before that. We got 50 before that. And we got 40 before that. So as you can see, there's a lot of moves in there that do not move. There's a few that do move big. You could check out the 8 o'clock possibly. Hop in at 6. You could do an 8 o'clock iron condor, or you could, go for a strangle if you think it's cheap enough. Just understand what our averages are. Only 54% of the time does it break. 62% of the time, by the way, it does break on Aussie yen. 54% does it break 50 pips. But the average range is less than 50, meaning a lot of moves that are like 2 or 3 ticks. Okay, I mean literally, it's really small. Hopping on over, we got the British PMI. Okay, pound PMI. Pretty big average moves, except for euro pound, 12.5% of the time. It breaks 50 pips, and average move at 30 pips. Might be an iron condor there. Looking at the pound dollar, pound yen. Okay, we're looking at just over 50% of the time does it break 50 pips. Moves somewhere between 60 and 70 pips on average. So, again, I like those higher averages on percent, 50 pips, really for my straddles and strangles. So really not getting that on that one. All right, so again, maybe a good iron condor trade. And looking over at the ADP NFP report, that's going to be coming out tomorrow morning and be released at 8:15. And not a big mover. Now, the NFP on Friday, big mover. ADP NFP, not usually a big mover. So lowest moving pairs out of the entire thing are going to be basically U.S. yen and Aussie dollar. Aussie dollar 25% of the time breaking 50 pips. U.S. yen 16% of the time breaking 50 pips. Average range 44 pips on both. Biggest movers, euro dollar, 54% of the time breaking 50 pips with a 60 pip average high to low. And let's see. Now, we do have a big moving trade here. We got the dollar CAD. It's going to be having its interest rate announcement, and it'll be coming out at 10 a.m. With a 70% of the time, it breaks 50 pips with an average range of 84. So that's going to be your big straddle as long as it looks good. Now, again, remember this whole model. Look how this thing had to move 80s. I want you to not forget this. Okay, this is an 80 pip like 1-to-1. Okay, either on a take profit or a stop loss. So really make sure you're paying attention, because if you end up being like at 100 or 120 pips, 1-to-1, when that interest rate announcement's about to come out, you might be a lot better off. Okay, you might be a lot better off doing an iron condor, because that could give you a really wide range. But anyways, 84 pips, 70% probability of breaking 50. Hopping on over to US ISM, coming out again tomorrow morning, the US ISM non-manufacturing PMI at 10 a.m. with all average low moves somewhere between 40 and about 50 on every pair being under 50%, breaking 50 pips. So a lot of neutral possibilities there. You take advantage of that high implied volatility with that low average move. Could be a perfect combination for an iron condor. Check them out, demo them out. Let me know any questions you got. Y'all have a great day. I'll see you tomorrow.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
You're watching Tiger TV.